Let's continue our ratio journey. We are working on problem 12.3a, and we've gotten down to the debt ratio, total liabilities divided by total assets. So let's see how we do here. Our company's total liabilities, I'll erase again my earlier calculations. Our total liabilities come from the balance sheet. There they are, 937 and 735. Our total assets, also from the balance sheet, 1375 and 1053. So 937 divided by 1375 is 0.681 or 68.1%. 735, oops, not 777, 735 divided by 1053 is 0.698 or 69.8%. Now let's think about what this ratio is telling us. Total liabilities as a percentage of assets. It's saying how much of our company is owned by debt holders. Obviously, you want less of your company to be owned by debt holders. As a general, some companies like to seek this leverage and can do things with this leverage, but as a general rule, lower here is safer, and safer is generally thinking better. So the fact that 70% of our assets are tied up in debt versus 68%, you'd rather be 68%. So this is getting a little bit better, not a ton better, but a little bit better from one year to the next. Times interest earned. How able are we to pay off the interest on our debt? So we take our operating income divided by our interest expense. Let's see. Erase those. Operating income. There it is. Interest expense. There it is. So 500 divided by 200. 300 divided by 150. So this one is 2.5 times, and this one is 2 times. So how many times am I able to pay my interest bill? 2.5 times this year, 2 times last year. We'd rather pay it off more often, right? Like, it's sort of like when you get a mortgage. If your paycheck only covers your mortgage, double your mortgage, you don't have as much to live on. If it covers 2.5 times your mortgage, then you got more to live on. You'd rather be in the 2.5 camp than the 2 camp. We got better here. Okay, let's continue down to profitability. Gross profit percentage. Gross profit divided by net sales. Okay, so gross profit 2.1, sales 3.6 million. That's 2017. Oops, 2.1 over 3.6. I was thinking that was a pretty low markup. And last year it was 2.3 and 3.9. So 2.1 million divided by 3.6 million is 58.3%. And 2.3 million divided by 3.9 million is 58.9%, or we'll round that up to 59.0%. So last year was a little bit better than this year. This is the markup, right? If all else equal, you want to be able to mark your product up more. It means you make more from every customer. We're like, percentage points worse, but we are worse. There's no doubt that you'd rather be 59 than 58.3. And, in huge companies, like a 0.5% difference can be millions of dollars. So definitely even in a small company, if you're just 0.5% off or 0.7% off as this is, you'd rather be on the high side than the low side. Okay, return on sales. Net income divided by net sales. So we already have our denominator, right? 3.6 million, because it's the same. And the one above, or the one last year, was 3.9 million. So let's see our net income then. Our net income, just the bottom line, 215 and 110. Yes, sorry, I was just double checking something real quick. 215 and 110. $215 divided by 3600, 0.597 or 5.97%, and 110 divided by 3,900 is 2.82%. So what would you rather be making in profit? 6% of your sales or 3% of your sales? Obviously, this one on the left is way better than the one on the right. This is significantly better. ROA, and I'm going to suspect, given that our profit and our sales were a little lower, but our profit was way, way higher, I'm going to tell you that anything like return, earnings, I'm going to suggest to you that we're going to be better across the board in 2017 because our profits were so much better. So that's going to be the numerator in all of these items. It's going to drive the numerator, and it's just going to be way higher than the year before. So let's see how we do. So return on assets. This tells us how much profit our assets are generating for us. Net income, 215. Net income, 110. Now interest expense, did we just compute? We had it up above. Oh yeah, there it is as a denominator up here. So 200 and 150. So plus 200 plus 150 divided by our average total assets. Well, let's go up to our balance sheet. There's our total assets. For 2017, I want the average here. For 2016, I want the average between these two. So let's just do them quickly in the calculator. 1375 plus 1053 equals, divided by 2, 1214 is our average for 2017. And for 2016, the average is going to be 1053 plus 905 equals, divided by 2, 979. So 1214 and 979. So let's do the math. 215 plus 200 divided by 1214, 34.2%. $110 plus 150 divided by 979, 26.6%. As I suggested, we did get better. A common question here that students have is, well, why isn't it just net income divided by average total assets? And the idea here is, part of net income, in getting to net income, is the interest expense, which is our borrowing cost. And we borrow to buy our assets, right? We borrow money to buy our assets. So it's saying, look, let's just assume we were not borrowing any money at all. How productive would our assets have been? And so we take out those borrowing costs. We take out the interest expense, which is a cost of borrowing, to say this is how productive our assets are, kind of removing that borrowing cost from the equation. So that's why we add back the interest expense there. Okay, let's do the next one. Net income minus preferred dividends divided by average common shareholders' equity. Okay, our net income is just the same, 215 for this year and 110 for last year. Preferred dividends, I didn't even really read those. Let's see. Preferred shares, $20, 1,000 shares all years. So remember, $20 is the guaranteed dividend. 1,000 shares all years means there's a $20,000 preferred dividend every year. So net income minus the preferred dividend, which is 20 grand. So minus 20 grand in the case of both years, divided by average common shareholders' equity. Now, why do we take preferred dividends out? Well, Preferred dividends go to preferred shareholders. Profits go to common shareholders. So even if we pay common dividends, we don't take those out. But we take the preferred dividends out because they don't belong to the common shareholders. Common shareholders basically own the equity, and we're saying the preferred shareholders, we want to take out their piece of the equity. We'll take out their dividend when we compute this ratio. So 215 minus 20 divided by the average common shareholders' equity. What is our common shareholders' equity? Well, it's common shares, retained earnings, AOCI if we have it. It's pretty much everything that's not attributable to preferred shares, which would be preferred shares. So it's this 100 and 188. So it's 288 for 2017. It's 193 for 2016. And it's 110 for 2015. That's our common shareholders' equity. Now, I need to take the averages, though. So 288 plus 193 divided by 240, 500 is my average common shareholders' equity for 2017. And for 2016, 193 plus 110 divided by 151.5. So let's do a lot of math here. 215 minus 20 is 195 divided by 240.5, 81.1%. These are big numbers, by the way. 81.1%. 110 minus 20 equals divided by 151.5, 59.4%. Okay, so what year did we generate better returns for our shareholders? Well, obviously 2017, it's a bigger number and it's a better return. So we got better from one year to the next. Okay, moving on to EPS, earnings per share. Net income minus preferred dividends. Well, we have that. 215 minus 20. 110 minus 20 divided by average number of common shares outstanding. Well, let's see. 50. It says common shares, 50,000 shares all years. So the average number of shares outstanding is 50,000. So 215 minus 20 divided by 50 means we earned $3.90 per share. 110 minus 20 divided by 50 means we earned $1.80 per share. That's our earnings per share. So the number of shares out there, the earnings attributable to common shares, which is 215 minus 20, 50,000 shares out there means every share in the company earned $3.90 in profit. This is a number that really gets scrutinized in public companies. People look very, very closely at this number to see how the company's performing. And sometimes they'll tell the company will tell the investor, oh, we think we're going to be around $3.80 a share, right? And then they come out and the announcement comes and they finalize their financial statements. It turns out they're $3.90 a share. You might think, oh, that's really close. The stock will jump because the earnings per share beat investor expectations. So this is like a number that gets scrutinized to no end when we look at real companies and stock market investing. Okay, so anyway, we definitely did better in 2017 than we did in 2016. Last couple here, price to earnings ratio. So these are stock market performance ratios. They tell us how well the stock is performing. Market price per common share divided by earnings per share. So market price was 150 in 2017, 50 in 2016. So 150 and 50. and we divide by earnings per share divided by 390, and the year before divided by 180. So what this tells you is almost the value in the stock market. 150 divided by 3.9, 38.46 is my price to earnings ratio. It means for every earnings per share, every dollar earnings per share, I got to pay $38 to get $1 of earnings per share. I can tell you this is a huge number compared to real companies. The year before, 1.80 or 50 divided by 1.80, 27.7. Okay, this one's a tricky one to measure because it really depends on who you are. If you owned a share last year and you own one this year, you're very happy to see that number go up, right? The market is kind of overvaluing your share. If you're a potential investor thinking of investing, you want this number to be as small as possible because you want to get a bargain, right? This is definitely not a bargain. 38 is definitely not a bargain compared to 27. The lower the better for a potential investor. If you already own the share, the higher the better. You'd love to see this thing pump through the roof because you're making more money off of it. So I'm going to look at this from a perspective of somebody that owns the share. And if you owned this share for that full year, you'd have been happy to see this happen. It means your stock price is done really well in relation to the earnings. Dividend yield. So this tells you how generous the company has been with dividends. So dividends per share divided by market price per share. So our market price is 150. We have our dividend there, $2. So 2 divided by 150, and the year before is 1 divided by 50. So 2 divided by 150 is 1.33%. 1 divided by 50 is 2%. So it means if you bought a share last year, you would have gotten a 2% of your investment back in terms of a dividend. If you bought a share this year because the stock price is up, even though the dividend went up, you're only getting 1.33% dividend yield because the stock price is so expensive. So this is worse. From an investor perspective, you would rather get a higher dividend yield rather than a lower dividend yield. Whew. All right, this was a lot of ratios. It was actually more than I bargained for when I was planning this problem. I thought it would take less time than it has. So let's kind of scroll back up and just look at the overall performance of the company. In terms of liquidity, I would argue it's marginally better. I know the current ratio is a little bit worse, but the acid test ratio was significantly different. It was significantly better. So I would say this is in a safer position in terms of liquidity. Because again, the difference between 2.14 and 2.02 for a current ratio is not significant. The difference between 0.56 and 0.75 is significant. It's a bigger jump, and remembering that our magic number is around 0.9 or 0.1, we've definitely made big gains here. So I would say in terms of liquidity, we had a good year. In terms of turnover, a really poor year. This is an efficiency measure, and it sort of says, okay, how quickly are we selling through our inventory? Not quickly at all. How quickly are we collecting on receivables? Well, maybe this one's a little less critical. If a company has an average days to collect their receivables of 11, that's really fast. 6 is amazing. So we went from amazing to really great. We went from an A++ to an A+. Well, an A+ is still really good. But the inventory turnover and the day sales in inventory is definitely not great, and it definitely deteriorated. So in terms of turnover, we did worse. Debt paying ability, marginally better. Profitability, way better. Our markup was just a little tiny bit worse. Everything else was better, and in fact, way better. And the stock market, our stock performed well in the stock market. Our stock price really leapt up. I'm not surprised dividends yields fell because the denominator is stock price. Well, the stock price had a great year. So in terms of profitability, debt paying ability, we're better. The areas of concern for the company, I think the big area of concern is inventory turnover. That would be my big concern. Other than that, though, I think this company had a good year, and in terms of profitability, a great year. So that would be my comment on company performance here. I hope this video group has been helpful for you, and you can stay tuned for the next video.